Well, good afternoon, everyone, and welcome to our Sustainability Investing webinar. I hope everyone is doing well, staying healthy, staying safe, and staying sane during these unique times. I am your host, Andrew McGill, and I'm a financial advisor here at the Bullfinch Group. And we wanted to start by thanking everyone for taking the time from their busy schedules to join us as we discuss this very important topic. During the webinar, you'll hear from sustainability expert Ryan Hagan, who many of you may know from his newsletter and nonprofit Crowdsourcing Sustainability. If you haven't seen it, I really recommend you sign up and check it out. You'll also hear from my colleague Derek Mazzarella. Derek is a certified financial planner and a member of our investments department here at the Bullfinch Group. Before we dive in, just want to go over a couple housekeeping items. This webinar is being recorded, so for those of you who may have to leave early, we will have this recorded so you can see it afterwards. Make sure that your phone is on mute. It seems like everyone is on mute. Make sure that your computers are on mute as well. So we all know those calls where you can hear someone putting their groceries away, so please, we just ask that. The last piece is questions. We reserve some time at the end of the webinar to go through questions that people may have. As the presentation's going on, feel free to just type in your questions. And if there are a lot of the same questions, we can stop and answer them. Before I turn it over to Ryan, I just wanted to make one thing known, that Ryan does not have any sort of affiliation with our firm. The only affiliation Ryan has is with me, and we've been friends since middle school. It wasn't until a few months back, pre-COVID, which feels like years ago, where we were grabbing lunch and we were discussing sustainable investing, and we came up with this idea for the webinar. We thought we could team up and create something useful and interesting for people given the intersection of our work and how important this topic is to not only everyone, but to us as well. Our hope is that you come away with a greater understanding of climate change as well as sustainable investing. And moreover, we hope that you leave this webinar with some tangible action items that will make a difference for our world both today and into the future. So with that, it's my honor to turn it over to Ryan, who will share with you some info on climate change, how it's impacting investors, and investments in general. Take it away, Ryan.
Thanks, Andrew. And hello and welcome to everybody. Thanks so much for joining us today. My name's Ryan Hagan, and I'm the founder of Crowdsourcing Sustainability, which is a global community and nonprofit. And I'm super excited that there's so much interest in this topic, and it looks like we've got a pretty big turnout, which is really cool. To build on Andrew's intro, I just wanted to start by reiterating why I was excited to bring this event to life. I saw this as a chance to spread awareness about the climate crisis to new people, and hopefully get some folks to consider divesting from fossil fuels because it's an impactful action to take. And this is a good chance to learn more about sustainable investing options like ESGs and SRIs from actual financial professionals, which I am not. And just to be totally clear on that point, I'm a huge sustainability nerd, not a financial advisor. So I'm simply sharing what I've researched and my personal thoughts on investing through a climate lens. So please do your own homework and follow your own best judgment when it comes to investing. All right, so let me share a bit about my story so you know where I'm coming from, and then we can dive in. So like I said, I'm a massive sustainability nerd. I've been obsessed with addressing climate change for about 8 years now. I first heard about the climate crisis back in college. And was kind of shocked because nobody was really talking about it or doing anything about it, even though it sounded like this massive problem. So I dove in, started learning everything I could about it, eventually added a sustainability minor to my economics major, and made a promise to myself that I would make a career out of stopping global warming because it meant that much to me. I couldn't unsee this thing once I saw it, and I realized basically if we get climate wrong, nothing else is going to be right. It's just that big of an issue. So I worked in clean technology for a few years before deciding to start my own organization because we still aren't moving fast enough as a society And the whole idea behind crowdsourcing sustainability came from the fact that I'm only one person and can only do so much. But if I could get as many other people as possible working together on these solutions, then that could have a pretty big impact. So crowdsourcing sustainability exists to help reverse global warming ASAP. And for the last 2 years, I've been building this community by writing a newsletter to inform minds, touch hearts, and inspire action. So now there's over 60,000 people from over 100 countries who are reading this newsletter. And we just launched a Slack community so people can start connecting, collaborating, and multiplying our impact. So that's super exciting. So that's a bit about me. And I saw a bunch of names I recognize in the webinar here. So quick shout out to all of you in the crowdsourcing sustainability community. And I really appreciate all your support. It means the world to me, helps keep me going more than you know. And none of this would be happening without you. So thank you for that. All right, so let's dive in. How will the climate crisis impact investing? So the first key point I'll cover is that the climate emergency is changing everything. I'm going to go over what some of those changes are and why they matter. And that's going to lead to the second point, which is that the vast majority of fossil fuels are unburnable. This in turn is going to take us to the third section, which is about the investing implications of all this and what the experts are saying and why values-based investing actually can produce better results. All right, so I want to start with this quote by Joe Rahm, who is a climate expert and worked in the Department of Energy. He's also an award-winning writer. And he says that everyone needs to be educated on climate change because climate change and our response to it is going to change the world over the next 25 years as much as the internet did in the last 25. So this is one of, if not the macro trends of the 21st century. And we could debate whether or not this provocative statement is going to come true, but doing so would actually miss the point. The fact that the threat of climate change is even in the ballpark of that magnitude, which it definitely is really what we need to start wrapping our heads around. So why and how could this issue possibly change the world so much? Everything is going to change drastically because though we take it for granted, the climate is the context in which everything else takes place. And these changes are relatively permanent on human timescales. It's not like you can unmelt the poles or stop the sea levels from rising. You can't really undo extinctions or collapses of ecosystems that we rely on. And I think this chart from the UN shows that fairly well, that this is really the foundation of society and the economy, the environment is. And to add some more color to that, Alex Seffin, who's a futurist and climate expert, says that climate change isn't just another issue, it's an era. So to get a little more granular, we're talking about the physical impacts here. Climate change impacts the very building blocks of society. So we're talking about our food supplies, water supplies, human health, the economy, the basic habitability of where we live. And these are all increasingly at risk due to extreme weather, rising seas, loss of wildlife. And all these things don't happen linearly. They're compounding over time, and they interact in unpredictable ways because everything's so interconnected with each other. And so just to go over some of the pictures here, in the top left, we have agricultural pictures. I put these in because with every degree of warming, the crop yields are starting to shrink and the food itself is actually becoming less nutritional. If you look in the top right, you see a line of people. This is in Cape Town, South Africa. They're lined up for water. I think it was 2018, South Africa or Cape Town almost ran out of water. And so they had this day zero. They put in all these measurements to try to extend day zero as far back as possible. And they got lucky, it rained. But this was after unprecedented drought for 2 or 3 years. Bottom left, you have Paradise, California. This one, I'm pretty sure, is the Midwest. We had some massive floods in the Midwest recently, and it took out all sorts of crops. I have a mosquito here that you could also talk about Lyme disease, but all these disease vectors, their habitats and their range is starting to change. So they're moving to different places that aren't used to them, and some of them are reproducing more often. And then this in the bottom right, I believe it's in India. And this just is going to show that the very infrastructure that we rely on isn't built for this changing climate. And this is a very minor example of that. But this is really about the basics of food, water, human health, our livelihoods, and a safe place to live. So just so you can hear what some people are saying about this, the Department of Defense is calling climate change a threat multiplier, and that it poses an immediate risk to U.S. national security. United Nations is projecting 25 to 1 billion people being displaced from their homes by 2050. The average that they're coming at is around 200 million. That's what most people are citing. And then the World Health Organization is conservatively estimating that climate change will cause 250,000 deaths each year by 2030. And so to kind of look at the big picture here, where do we stand now and where are we going? Right now we're at about 1.1 degrees Celsius warmer than we were in pre-industrial times. And the important numbers here, or some of the most important numbers here, are the 1.5 degrees Celsius and 2 degrees. And these were part of the Paris Agreement. So basically every country in the world agreed that we should aim to limit warming to 1.5 degrees. But where was I? Yeah, so the 1.5 degrees and 2 degrees are kind of the big numbers to know about. 1.5 is what we ideally should be aiming for, and 2 degrees is kind of this last line in the sand that we really, really, really shouldn't cross. But even at 1.5, there's a slogan from all these island nations, 1.5 to stay alive. And they're saying that because if we go past that, it's quite likely that their islands will go underwater. And just like with every little bit warmer that it gets, you have millions of more people who are going to be suffering from lack of the most basic things. And so Paris was a big win in one way and doesn't have enough teeth in another. But as of right now, if the countries fulfill all their pledges, we'll be at like 3.2 degrees Celsius warmer, which isn't even close to good enough. And at the very extreme, just to put in perspective, like how bad this could get, those hippies over at the World Bank, they're saying that there's no certainty that adaptation to a 4-degree world is possible, and that the projected warming simply must not be allowed to occur. So this is like very, very serious stuff, and my hope is that society starts to make sustainability kind of the key thing in decision making, the organizing principle for everything we do. And so another chart to kind of explain this is, I like it because it moves and it's kind of puts this in perspective well. But basically what you're looking at here is on the y-axis, it's the amount of CO2 emissions, and that's what's happening over time. So you can see that the world's emissions trajectory is very high. What was pledged under the climate agreement, under the Paris Agreement, is a little bit lower. That's right here. And what's needed for staying below 2 degrees is way down here. So we have a very far way to go. And I have a couple charts here. Some of the key things on the one on the left, this is from the UN. And one of the key things is that they're saying that all sectors are really going to be impacted by this. The IPCC, which is like the gold standard of climate scientists, says that we need rapid and far-reaching transitions in energy, land, urban and infrastructure, transportation, buildings, industrial systems, and that these transitions are unprecedented in terms of scale, but not necessarily in terms of speed. Another key thing in this chart on the left is that they say that the current mitigation efforts must be tripled to limit warming to 2 degrees Celsius or increased fivefold to limit warming to 1.5 degrees. And on the right, this is another UN chart. This is from the Production Gap Report. And it's basically saying that the fossil fuels that we have like planned to produce is way up here. The climate pledges under Paris are here. That's how much we would produce if we listen to that. And then way down here is what you would need to limit warming to 2 degrees Celsius or 1.5 degrees Celsius. So you just see this massive difference between the track we're on and what science says is necessary to keep the planet livable, basically. And so some more stats on that. The world's on track to produce 50% more fossil fuels by 2030 than would be consistent with limiting warming to 2 degrees Celsius, and on track to produce 120% more than would be consistent with limiting warming to 1.5 degrees Celsius. So those are kind of the two main ways that the climate emergency will change and is changing everything. We'll be dealing with the ongoing worsening physical impacts of climate change in our communities and the interconnected world. And the second way is that society will inevitably at some point respond to stop the problem from getting worse. We're gonna respond to keep the planet livable. So this brings me to the second key point. So like what all this means is that if you do the climate math, we can only burn so much of this carbon. We can only burn this much carbon to prevent catastrophe. And this is how much fossil fuel companies say they will sell or burn. And so like I don't know if you can see my mouse or not, but on the left here, the first bar chart is 2 degrees above pre-industrial temps. So think of this as like a budget. We can burn this much CO2. And if we burn only this much, we'll have a 66% chance of limiting warming to that threshold. Similarly, to limit warming to 1.5 degrees, if we burn only that much, only this much on that second middle bar, then we have a 50% chance of limiting warming to that 1.5 degree level. But this big one on the right here are the reserves that fossil fuel companies are saying they're going to sell and then will be burned. So you have this massive difference between what they're saying they're going to do and what the science says is necessary. And this is why, this is Mark Carney in the top right here. He says that the vast majority of reserves are unburnable. So this is really the second key takeaway for all this. Another way to say this, Bill McKibben is the one who actually introduced me to this global warming math. He says this is literally a math test and it's not being graded on a curve. It only has one correct answer. And if we don't get it right, then all of us, along with our 10,000-year-old civilization, experiment in human civilization will fail. So pretty drastic stuff here. And what does this math mean for investments? It basically means that these companies' business model, what they're telling everyone they're going to do and sell, is not compatible with a livable future. It's going to completely change what we see as valuable. And there's this term stranded assets that's getting tossed around a lot, rightfully so, because a lot of the infrastructure and investments that these companies are making now aren't going to be able to be used for their entire lifespan because the science doesn't, it basically says we can't do that if we want a habitable planet. So what this means is that over 60% of fossil fuel reserves must stay underground to limit warming to 2 degrees, and 80% of reserves would have to stay underground to limit warming to 1.5 degrees. And as Alex Steffen puts it, fuels that can't be burned aren't worth much. And in turn, the companies whose major assets are those coal mines, oil fields, and gas wells, pipelines and refineries are worth much less money than their stock prices would indicate. So there's a lot on this page. Basically, I just want to point out some additional trends that are going against fossil fuels. They have all this very clouded, untalked about debt that's called asset retirement obligations. I'd encourage you to look into that if you're intrigued. It's basically them not covering up the environmental damage that they're causing, even when they're done using like the oil well or the pipeline or whatever it is, and they're required by law to do something about that. They're facing increasing lawsuits. You see more and more every week. Some of the big ones I'm excited about are this $14 trillion divestment movement. That means investors who have $14 trillion are in the process of divesting or already have divested from fossil fuels. And the economics on this are just crazy favorable and, again, changing very quickly to renewables and clean energy. So carbon pricing is picking up steam around the world. Fossil fuels have tons of subsidies that don't get talked about enough, like way more than renewables. The IMF, International Monetary Fund, estimates that including indirect subsidies, so like the societal costs, they're getting about $5 trillion from taxpayers. Renewable energy is also now cheaper in 2/3 of the world, which is huge. And another big one, I think, is that more and more people are realizing that the fossil fuel industry has spent billions of dollars on disinformation campaigns and lobbying to delay climate action, even though they knew that this was as bad as it is like 40 years ago. Their scientists were some of the first to tell us about climate change. Another important fact, I think, is that air pollution from burning these fossil fuels is already killing, millions of people every year. So the financial industry is starting to see the writing on the wall. You have Barclays saying that the fossil fuel industry risks losing $33 trillion in revenue. Citigroup is saying stranded assets could be over $100 trillion. They said that in 2015. And just last year, a coalition of 34 central banks released a report, which if you're interested in this, I'd recommend. It's quite strong, saying that we need to take action to avoid a quote unquote climate-driven sudden collapse in asset prices. You have big banks starting to say they're not going to fund any more fossil fuel projects, and BlackRock, the biggest asset manager in the world, is making sustainability the cornerstone of their investing strategy. So this leads me to my last point, another big key takeaway, and that's that values-based investing can produce better results. This is the CEO of BlackRock, and I found this extremely powerful because of how dominant they are in the industry and people look up to them. But he just wrote this year that as a fiduciary, our responsibility is to help clients navigate this transition. Our investment conviction is that sustainability and climate integrated portfolios can provide better risk-adjusted returns to investors. And with the impact of sustainability on investment returns increasing, we believe that sustainable investing is the strongest foundation for client portfolios going forward. So all of this is to say that things are changing very quickly. More and more people are starting to really wrap their heads around this emergency. And this means that values based on investing really can start to produce better results. And I personally believe that sustainability is the future of the economy because it has to be. Just real quick here, this is just to show that fossil fuels have been doing terribly for the last decade. This black line going up is the market overall, and these red lines are different fossil fuel ETFs. One quick example is that if the New York State Common Retirement Fund had divested 10 years ago, they'd be $22 billion richer, which would mean almost $20,000 more for each of the members and retirees. There we go. And so now to some of the good stuff, like what you can do, how do you bring this down to the level of the individual? There's a quote from Vanessa Green, and she says approximately 8 to 12% of the over $4.4 trillion currently invested in 401ks is in fossil fuels. And that's 352 billion to 528 billion worth of influence in the hands of employees. That number, 8 to 12%, is a little lower now because of how poorly they've done since she said this. It's probably like 5 to 8% in your standard average 401k portfolio, but that's still very significant given the risk of this investment, not to mention the moral implications. But to kind of show you the potential impact of making your portfolio green, the Bank of Nordea, which is one of the biggest banks in Europe, says that if you make your financial assets green, you could generate 27 times greater improvements in a personal carbon footprint than eating less meat, using public transport, reduce water use, and flying less. And I'm not sure if this is really quantifiable or like how accurate it is. This is literally the only thing I can find of someone trying to estimate the impact of this. But even if the study is only directionally accurate, say they're off by like 50% or 80%, it shows that sustainable investing probably does have a fairly meaningful impact. And so some ways that you can take action, I would highly recommend that anyone who is interested in re-examining where your money is to go check out the Fossil Free Funds tool, which was created by As You Sow. Here you can see your exposure to fossil fuels. They also have a toolkit that you can use that will help you to get your company moving on providing sustainable 401k options. And like that would be massive if you can get your company to start making moves on that. I know a few people in my community have started to do that, and that is like music to my ears and the coolest thing. So work in progress, but people definitely want this stuff. You'll find employees on your side. Other ways to take action, as always, keep learning. Please make sure to do your research and or speak with an investment professional before making any changes. Do not blame me, please. And spread awareness about this stuff to anyone who may be interested. So this is just a quick screenshot of you what that tool looks like. You can put in whatever funds you own up here, and they'll give you the grades and a lot of good info on any value related stuff you might be interested in. You can see how it's doing on deforestation, how it's doing on gender equality, weapons, tobacco, etc. And of course, the fossil fuel grade. So there's a lot of good info here. Definitely encourage you to check that out. And kind of to start wrapping up here and hand it over to Derek, getting into ESGs, which are one of the ways that you can invest in sustainable stuff. I spoke with the ESG SRI expert over at the Royal Bank of Canada a couple months ago, just to get the lay of the land a little bit better. And he sent me this chart, which is the first ESG fund created against the market for the last 30 years. And he told me that it outperformed the market every single year, except maybe one, or every year, I forget which, but that's the oldest and it's done quite well. And here's another chart from Calvert, and it's just comparing the strongest ESG scores, the firms with the strongest ESG scores to those with the weakest ones. And you can see the performance difference there as well. So I can't say what the future will hold, obviously, and I'm sure there are ESG funds out there that have underperformed the market, but what I'm seeing tells me that values-based investing definitely has the potential to produce better results. And so just to wrap up, I want to share those 3 key takeaways again, that the climate emergency changes everything, that the vast majority of fossil fuel reserves are unburnable, and that values-based investing really can produce better results. And so with that, I think we can turn it over to Derek.
So while Andrew's giving me the controls, basically my goal is to really do a few things with my part of the presentation is give you some history and some background on sustainability investing, help you understand the terms, because there are a lot of different terms that go into this. So knowing which one makes the most sense for you, and then give you a little bit of background on performance and what are your options in terms of investments moving forward. So I'll get right into it. Basically, the history of investing and responsibility actually goes back to biblical times. Actually, looking back, Jewish law mandated essentially ethical investing in a practice called zedek, which means justice and equality. And then we kind of had a long lull for a while, but then in the 60s, there's a lot of activists came along, was concerned about the environment, but the investment community didn't really catch up until about the 80s when SRI mutual funds were actually founded to help fill that void in the industry where people were having a demand for these types of funds where nothing really existed. And then over time, these really evolved into creating more of these ESG, ETFs and mutual funds and managed accounts. And now it's gotten a lot more complicated. So I think it's really important to understand what the different types of investment options are and which ones probably would make sense for you if you are looking to invest in them. So I'll get a little bit. So the first one that most people are familiar with are called SRI funds, or socially responsible investments. So SRI funds really at its core are screeners. They really just look to screen out certain industries as a part of a mutual fund. So most mutual funds will have the same common core screeners. So it's typically the vice industries and negative climate impact industries. So for example, they'll screen out firearms, tobacco, oil companies, things along those lines. But I've also seen gambling. So different types of industries will be screened out in general. So they're just really going to be more focused on avoiding industries versus trying to look at things that are maybe making a positive impact. Okay. And then as we kind of evolve from SRI funds, this concept of ESG investing has come into play. And basically what the ESG stands for is environmental, social, governance investing. So ESG funds kind of have that same protocol as SRI funds, where they're really screening out negative industries, but they're also looking at some companies that have positive ESG scores. And I'll get a little bit of detail next about what each one looks at. But they really have kind of a dual approach of screening things out, but also looking at what companies are taking positive action in general. So what are kind of environmental factors that the screeners are looking for? So essentially, they look at a few categories. Most of them are energy consumption, like looking at how much energy a company consumes, what are they polluting, how are they impacting climate change, whether it's positive or negative. Looking at animal welfare, are they tearing down forests? Or are they really protecting the wildlife? What's their waste production? How are they, dispersing with all that? How are they utilizing natural resources? So they look at all of those things at a different level and say, okay, what is their ESG score on the environmental impact? How are they doing in that realm? And then we get to the social factors, and this is probably a little more topical today, especially. But how are they looking at, health and safety of their individual people? Like, I don't know if you know, back in the day, Ford had a Ford Pinto that was the company actually knew had faulty gas line and was lighting on fire. They chose to ignore that and say settling the cases was much cheaper for us to do. So that obviously would have a low health and safety score with ESG funds. They look at human rights, things like what's going on, employee relations, how do they treat the underlying employees that are going on, are employees allowed on boards, what is their engagement with the community, what are their child labor practices? I don't know, we had a lot of news back in the 90s about Nike. So things like that. What are the liabilities of their products? And also looking at the governance factors, we're looking at how is the top level management doing? What are they looking at? What are their conflicts of interest? Are their executive compensations completely out of line with the rank and file employees? Are they being transparent with what they're saying and what they're actually doing? When it comes to what their corporate messages are. So look at kind of all three of these factors in one. And if you kind of look compared to what the SRI funds are doing, they're really just screening out negative ones, but you can really see with ESG funds how they're really looking at, okay, let's lift up the positive companies a little bit more, and let's make sure we're putting more of our resources into those companies. So one other thing we look at is there's actually a few different types of investing we can look at. There's social responsible, there's ESG, but if you want to be really hyper-focused and say, okay, it's good that we're maybe screening things out, but I really want to invest my money in positive projects that are really focused, there's two other options you have. You have something called thematic investing, where they really focus on a particular social or environmental or governance issue. So for example, you may invest in a fund that's really targeted just on clean energy companies. So you could have a fund that's really focused just on investing in those companies. And then also you can look at doing some kind of impact investing, which where they look to basically they seek to achieve measurable, sustainable outcomes alongside a financial return. A good example of that is investing in green bonds that may finance environmental projects down the line. So there's really a variety of ways you can actually use your investment dollar to impact the economy and impact the earth and make a positive impact on things going on. So if there's something that's particularly important to you, you maybe want to think of more of the thematic investing. But if you really just want to have a kind of a broad-based approach, sustainable SRI funds or ESG funds can also be a good option for you. So hopefully that gives you an idea of some of the differences between the different types of options as well. So as you see here, there's actually been quite a significant trend in money being invested in SRI funds and ESG funds. So even getting back from 2014, so just 6 years ago, in 4 years' time, they basically almost doubled the amount of money going into the socially responsible funds. And I think what we really want to mention is what you're doing when you're investing in let's say, just a regular S&P 500 index fund where your money's going kind of across the board to all companies, is when you're giving, let's say, an oil company, for example, investment in buying their stock, you're actually giving them access to capital, which is helping them build a new refinery, drill a well somewhere. So the minute you take that money away, you're taking away their ability to actually increase and grow their profitability over time. So your investment dollars, whether it's direct or indirect through, let's say, an index fund, really can matter. And maybe your account may not be $20 million, but when all of us kind of, like Ryan said, crowdsources this and does this together, we're really looking at, as a whole, we can make a huge significant impact. And then what that says is, hey, we need to maybe change what we're doing, or we're going to stop seeing funds flow our way because no one's really investing in our company anymore. And that's kind of the overarching impact of these investments when you're saying, okay, let's screen out these bad actors, and let's focus our energy on the companies that are really making a true positive impact. Because if everything's going to flow based on where the money goes, so if all the money is going into this one direction, then companies are going to take notice. In my opinion, in general, there are really two major bodies that can really make a positive impact on this. One is the government, and we can really only control that with our vote and maybe our voice. And then the other side is big businesses. Big businesses have a lot of leverage and a lot of say. And if the CEOs of all these companies are saying, hey, look, this is more than just a fad, we really need to make sure we're taking advantage of this and making this instead of a problem, an opportunity, they can really make a significant impact than an individual person like you or I would be able to. So as long as we're doing that along with, hey, our investment dollars and with where we're buying things, that can really have an impact, even though it may not be direct, very indirect impact on maybe achieving these 1.5 degrees goal that we have. So kind of alluding to what Ryan said, I've seen this kind of more and more. Traditionally, I think back in the probably late 80s, early 90s, there's a big question mark of were SRI funds actually outperforming regular traditional investments. And I think when you look back, those investments tend to be a little bit more expensive, which typically would weigh down the performance. But the other thing to look at is really traditionally how we evaluated businesses back then. So when you're looking at traditional metrics, they tend to be very quantitative. So they're really looking at just the numbers. What's the revenue growth year to year? What's the earnings per share of that account? Do they have a lot of cash on hand? What's their cash on cash return? They really just look at it like a set of numbers. When you look at the ESG investing, now you're adding this whole extra layer of analysis and scrutiny to these companies to saying, okay, maybe their returns look good on their cash, but moving forward, what's their management team like? Are they picking up on these trends? How are they doing in terms of managing their relationships with their employees? Are their employees happy? Are they moving forward with positive human rights? So you're adding this extra layer, and typically managers that are in tune to a lot of those things tend to do better overall, especially over the long term. So I think that's probably why we've seen a lot of instances where ESG funds, especially if you look kind of over the last few years here, from let's say 2010 on, they really outpaced traditional investments, probably for that reason. And I think the other reason, kind of Ryan alluded to earlier, is when you're screening out companies like oil companies, it's somewhat of a dying industry. Their returns are going to be much lower moving forward than a fund that doesn't have those types of companies in them. So I can't guarantee that they're going to continue to outperform in the future, but that's kind of my take on why an ESG fund has typically been outperforming, especially lately, a traditional investment. Okay, and then so really the question is, and I know we had a comment coming here about saying, hey, this tool is very useful, but it doesn't really screen out companies that alleviate emissions as well. So there's definitely a bunch of different metrics out there when it comes to sustainable investing and how they vet the managers, and this is critically important. So I think one thing you can do on your own, and this is probably only if you have a lot of time on your hands, is you could actually read the fund prospectuses themselves. They tend to be a few pretty lengthy. They're probably about 50 or 60 pages each, so I wouldn't necessarily recommend that. But you can look and really see what their actually underlying investments are, the themes are. But if you don't have the time for that, there's a few third parties that are creating these metrics. Morningstar is one of them. They have a carbon metrics rating. They use a company that they actually purchased called Sustainalytics. They have kind of a two-part system. They use an AI tool to scrape for media data. They'll look at carbon emissions and a lot of the kind of the metrics part of it too. But then they also have a team that will actually physically go through and analyze individual companies and look at a lot of the ESG practices as well. But they tend to be a little bit more on the carbon metrics rating, so they're going to be a lot more focused. If your thing is more about just climate change, then I would say Morningstar ratings can be a good start because they'll focus very much so on the carbon footprint of companies. MSCI is also another one. They have ESG ratings. They go from a scale of CCC to AAA, very much kind of like bond ratings go. They have a very similar methodology. It's typically a combination of AI and also personal people screening things out. They look a lot more towards the UN path, the Sustainable Development Goals initiative a few years ago, and they kind of rely a lot on aligning up your investments with those goals. So they look at the companies and how they're doing within those goals, and they rank the companies based on that and rank the funds based on that. Thomson Reuters is also another option to look at and evaluate your funds. So I think it's really important to do your research, especially as we saw in the earlier slide. As this becomes more popular, there are going to be more companies that see this as a marketing and monetary opportunity. So you want to make sure that the funds you're buying are actually doing what they say they're doing. So it's really going to behoove you to take another step and just look at maybe another third-party rating system to say, hey, are these guys actually doing what they're saying they're doing when they're saying, hey, we've got these green investments, are they truly green? Are they aligning with your values? So in my opinion, as this gets more popular, it gets more important for you to do more screening, okay? So basically, you do have a couple other, this is more kind of an investment side of it. You usually have kind of three different options. They have just regular traditional mutual funds. So mutual funds are really just a manager is picking a collection of stocks and or bonds into one fund, and they typically have one theme. They might be like large U.S. companies, or they may be large green U.S. companies in this case. Then you go to the next step. You may have something called a managed account. Traditionally, what most people do is they buy 5 or 6 different types of mutual funds to try and create a portfolio. Managed accounts are really just one account you have that create a whole portfolio for you in one fell swoop. So they're layering in 5 or 6 ETFs in one fell swoop. We used to see a lot more ESG mutual funds. We've now started to see a lot more ESG managed accounts as well. So they're an option to have a diverse portfolio, or you can build your own kind of customized model. or mutual funds, or you can go to the third level and do your own customized model where you can screen out individual assets or individual investments and create your own theme. That typically becomes at a higher asset level. Typically when you have about $500,000 or more, that's when you can do a lot more of your individual picking of funds or stocks based on what you want to have for your particular ESG goals. Okay, so really, what can you do? I think understand that how you invest does have an impact, and it will be important for the environment moving forward. Manage your own investments with ESG funds, or you can talk to investment managers as well. Definitely talk to your 401k providers about offering ESG funds. I know still at this stage, they're still pretty rare, but they are available, especially with a lot of the big players. So if you have a plan through Fidelity or John Hancock or Voya or Empower, I know for a fact they all have ESG funds available. So definitely ask your company if they do have them. And also, you could choose to work with an advisor that is knowledgeable on ESG investing, because they can help direct you on where to go and how to invest and how your portfolio can be in line with your actual investment values. So here's our contact information. I think, Andrew, at this point, we can open it up to questions. So I don't know if you want to go through the chat and just look and see what questions people have in general, and we'll go from there.
One that stuck out to me was Graham. I don't know if he's still on the line, but he brings up the point that the methodology of the tool that I shared, although a helpful tool, he's saying it only focuses on how much the investments pollute and not necessarily how much they help to alleviate emissions.
Yeah,
and
that's something I've noticed from this before. But I was looking at it comparing, like, there's like a Vanguard Tech ETF or something, and it had an A rating. And while I agree, like, super cool tech's not the big polluter that necessarily coal or other industries might be. It's not also an alleviator like investing in a renewable energy company would be. But that was the point I was trying to make. So
yeah, totally, and I'm 100% with you on that. I unfortunately don't know of anything that gives you that next level of, okay, what is the actual impact of this company? If it exists, I would absolutely love to know about it. Derek, do you know anything like that?
I would say all the ones that I've looked at, MSCI's ratings would probably be the best, because they do kind of take into account all of those factors, and they're pretty comprehensive. I think the thing to know is that this is a very challenging thing to actually measure at this point, and I don't know if we have a foolproof system of vetting all of this stuff yet. But I think our job is to really just kind of do the best we can with the knowledge that we do have. But I think with that said, the MSCI one would probably be the one that I look at the most, because they look at kind of both sides of it, not just like the screening out of one thing.
Yeah. So hopefully that's a little helpful, Graham. I'll definitely be keeping my eyes open too. Another comment here, I'm just going to send your way, Derek. But yeah. Kelly asked, or she said, I have a 403B, which I'm not sure what that is. You probably know. My financial advisor is telling me that I hold no investments in fossil fuels, but has not much choice as far as investing ethically in other areas. Her advisor says, I'm doing the best I can with the 403B, and I'll have to wait until I retire to invest that money in SRI funds, and she wants to know if that's accurate.
I mean, it'd be very hard for me to say without looking at the underlying funds, but it's typically very common for them not to have socially responsible investing options in a 403B. So 403B, for those that don't know, is really just a nonprofit version of a 401k plan. It's just a company-sponsored plan. So short story, I would have to kind of look at what you have to give you a real accurate answer. But yeah, I would just ask whoever's managing your 403B to see what kind of socially responsible mutual funds are available to them. And if you know what provider they're with, typically the providers have a fund list on their website somewhere. So you may be able to even go to your person at your company and say, hey, look, I looked on the investments through, let's say, Fidelity, and they have, Calver funds over here. Can we add that to our plan? It doesn't cost anything to add them to the plan. So if they try and give you that rebuttal, there's no way that that's a true rebuttal. So I would just try and find that fund list that they have outside of your particular company's list, and then see what options they have in the master list. Because typically they have about 300 funds to choose from. So there's usually something available for them. So I'm sorry, Kyle, I don't know if I fully answered the question, but I hope I did.
You got it. Thank you.
Okay. Oh, great.
So I think that's all we got in the chat. Muddy has been sharing some useful.
Yeah, so I saw Money's question. So the way these funds work in general is they're typically, most mutual funds in general, and even ESG funds typically have certain themes. So you can actually have ESG bond funds. I tend not to see them as much, but they are there. So your risk level really depends on if you're going to be investing more in equities or companies, for example, or you're investing more so in bonds, because bonds tend to be safer than equities over the long haul. That while that may be true in some instances where ESG funds may be rated as riskier, in a lot of ways they're not. But I think one kind of maybe caveat to that is typically ESG funds are going to be more in the growth side of the equation. There's typically two types: there's value companies and there's growth companies. Value companies tend to be more established. They pay dividends. They typically tend to be companies like oil companies, but also like companies like Verizon and stuff. So they're going to be more established. Whereas growth companies are going to be solar companies, where you hope that in the future they will, increase in value and the revenue will grow. So companies like Tesla and most solar companies are typically going to show up as growth. So growth tends to be riskier in general. So it's kind of like a minutia argument, and I can see that, but there's definitely a different array of options with ESG to be conservative and risk if you want it to be.
Super helpful, Derek.
One of the things that Kelly had mentioned was having a 403B, and she couldn't do anything until retirement. Something that a lot of our clients don't know when they first come to us is that anytime they change employers, they're able to take their current plan or an old plan and they can move it into what's called an IRA, which is an individual retirement account. And within those accounts, there's a lot of times you can do much more customization, as Derek alluded to, with those three layers, being the mutual funds and managed accounts. So please know, if you have like old 401ks or an old 403B that you think that is just, you can't do anything with it, there are options for you. So I just want to point that out.
Sweet.
And I'll throw one more wrinkle out there. You're probably not 59 and a half, Kelly, but if you are over 59 and a half, they'll allow for what's called in-service distributions, which means you could take money out of your 403B or 401k before you actually retire, and then you can invest those in an IRA, like Andrew said, and invest them in ESG funds if you wanted to.
This is why we've got the experts. I'm in way over my head on this stuff. So does anyone else have questions? I don't see any in the chat, but if anyone wants to just throw their mic on and ask anything, feel free before we wrap up.
We have one question here. Need a bit more. Okay. More of a comment than a question.
Okay, I think we're good then, right? Are there any further questions before we? Let's see, one just popped up.
And if you do have any other questions, please feel free to email us if it's about crowdsourcing sustainability or sustainability. Please feel free to email Ryan, or you can email Derek or myself.
Andrew, we just got one more question from Sarah.
Okay. Yep.
She asked, what do you recommend for someone who's brand new to investing but wants to start out making sustainable choices? So Sarah, I think you can really start looking at individual. Typically when you're first starting out, mutual funds tend to be the best way to get a diverse portfolio right away. So I would check out mutual funds that are along those ESG lines. One of the traditional ones has been Calvert. They've kind of started out. Harness is an option. I'm not making a direct recommendation, but there's definitely a lot of mutual funds out there. So I would start maybe recommend looking at those and seeing which one makes the most sense for you. Like I said, if you have any questions, you can feel free to email me directly. I could talk to you on a more one-on-one basis. That'd be helpful as well.
All right, we got
one more, I think. Yes, the PowerPoints will be shared, Seth. And then Aldis is asking, what about the blurry line of fossil fuel companies that are investing in low carbon, quote unquote, alternatives?
Yeah,
Do
great
ESGs
question.
screen those out too?
They do. So the good ones will. So typically, when they look at the fossil fuel impact, they're looking at percentage of revenue and percentage of business. So if 80% or 90% of the revenue is from oil, then they're going to notice that. Even if they have, let's say, hey, because I think everyone's probably seen that Exxon commercial where they have that green pond of algae, right? We know what you're doing, guys, right? So the ESG funds will screen those out in general. So I would definitely look at the underlying holdings of all of the funds that you're looking at, because that'll tell you whether or not someone like Exxon is in there. But generally, they are screening those out as well.
Okay, thank you.
You're welcome.
And Aldis, I know for that specifically, the tool that I shared, Fossil Free Funds, they definitely dive into that. So if you were like looking for a particular, if you have like a ticker or a symbol to throw in, they'll be like, yes, they have some that you should know about, or no, you're totally good, and give you exactly the info you need.
Great. Thanks.
Cool.
And while we're waiting here, I just want to say for anyone who got on late, I just want to be clear that with all the investing and things like that, there is no affiliation that Ryan has with our team. Ryan and I are connected as two good friends that grew up in middle school. And this is very important to us that there is no affiliation there. Happy to speak with all of you and just help you educate you more.
Good stuff. All right. I say we wrap up then. And then, Andrew, you're going to be sending out this recording to everyone and slides. And if anyone has any questions, you can reach out through that.
Wonderful. Thanks for everyone for taking the time. Have a great day.
Thank you.
Thanks, everyone. Stay safe. Be well.